Hi guys, and welcome to another week ahead video. Now in this week's video, our focus remains on the US dollar with the upcoming FOMC meeting later in this week. Now a lot of speculation on whether the Fed will over-deliver or under-deliver at this meeting, and there's really a lot at stake both in the equity, bond markets and the currency space. So jump with us now into the video to see exactly how we can prepare for this FOMC meeting and trade it in the upcoming week as well. Okay, and then looking at the US dollar's baseline for this week. Now, the dollar has seen both a lot of up and downs in the past 2 weeks. The downside was mostly driven by the market's aggressive increase in Fed rate cut expectations due to the fears of the economic fallout from the coronavirus. Now, just 3 weeks back, the markets were pricing in a mere 25 basis point rate cut for the Fed in 2020. And just 3 weeks later, the Fed saw an additional or emergency rate cut of 50 basis points. And also the market's still expecting another 100 basis points worth of easing for the Fed in 2020. Now, the dollar also failed to find any meaningful safe haven bids despite the very fast escalation of the virus throughout the globe. And this was largely driven because the Fed's monetary policy has a lot more room to the downside when compared to something like the ECB as well as the BOJ. Now, this week, the dollar saw some upside for two reasons. Firstly, the downside moves seen in other majors, more particularly the euro, that did see some additional support coming into the dollar. And secondly, we also saw big demand for dollars later in the week due to a liquidity shortage in the treasury financing market, as well as investors rotating back into cash in the wake of the market turmoil that basically saw some further demand coming in for the US dollar. Okay, then looking at the baseline for this week's risk events. Now, we do have a couple of events coming up for the dollar, like retail sales, but the biggest focus will definitely fall on the upcoming rate decision for the Fed. Now, the big question that the market has for the Fed this week is whether the Fed will be willing to under-deliver or over-deliver on the market's current expectations. Now, it's very clear that the market saw the Fed's 50 basis point emergency rate cut as being insufficient to deal with the current crisis, as we did see equity markets printing its biggest one-day decline since the 1987 Black Monday flash crash just this week. Now, according to CME FedWatch tool, the markets are currently pricing in a 100% probability of a 75 basis point rate cut and also pricing in an additional 70% probability of a 100 basis point rate cut. Now, the other question is whether the Fed will be willing to over-deliver and also introduce something like QE, another official round of QE, which will basically be the fourth official round of QE since the global financial crisis. Now, what is important is on Thursday, we also did see that the New York Fed did announce that it will provide $1.5 trillion worth of liquidity as part of its temporary repo operations. Now, after these actions, there are some doubts from some market participants whether the Fed will rather want to under-deliver and not introduce another round of official QE. Now, a majority of investment banks have said that there is a major burden on the Fed this week to go in to basically go all in at this upcoming meeting, which does pose a risk of potential upside in the dollar if the Fed is not aggressive enough. Now, looking at some potential sentiment shifts in terms of dovish sentiment shifts first, there are a lot of negative expectations on the Fed to deliver big enough easing measures this week in order to stop the bleeding in the equity space. Now, we can expect a dovish reaction in the dollar if the Fed over-delivers this week on rate cut expectations and cut by 100 basis points or more. Now, this is not out of the question actually this week, as the Fed has clearly explained previously that it would rather be ahead of the curve than behind the curve and would rather prefer to move aggressively and act more proactively. Now, given the lack of monetary policy ammo that the Fed has, it would make sense for the Fed to act big and basically take rates down to 0.25% or even 0%, which would mean either a 100 basis point cut or a 125 basis point cut, and would highly likely see some dollar downside as well. Now, another point to consider is what the Fed says about QE. There are some investment banks like Scotiabank and ING that is expecting the Fed to officially start another round of QE, with the possibility of announcing asset purchases of both treasuries as well as mortgage-backed securities in the range of 30 to 50 billion US per month. Now, an announcement of additional QE despite this week's major liquidity measures would signal that the Fed does mean business and would highly likely weigh on the dollar, as it would theoretically mean an increase of dollar supply, which should lead to lesser demand and thus see dollar weakness as well. Now, looking at some potential hawkish sentiment shifts, with the market's current pricing, there is more risk for potential disappointment by the Fed, which could lead to some further upside in the dollar. If the Fed comes out right on expectations with a 75 basis point cut, or even worse, a 50 basis point cut, that would see some potential dollar upside, as the market's already leaning towards a 100 basis point cut with a 70% probability. Now, if we do see a cut of just 75 basis points, that will likely see an initial knee-jerk reaction to the upside for the dollar, but there's also downside risk in such an event, as the dollar can see additional downside after this if markets are disappointed and once again places more pressure on the Fed to deliver even more easing in that upcoming April meeting. Now, with some participants leaning towards a possible round of QE, we could also see some additional upside in the dollar if the Fed cuts only by 75 basis points or less, and also explains that they are not at all at this point interested in any scope for further additional rounds of QE. Then looking at currencies that we can look to pair against the US dollar. Now, pairing the US dollar in the case of a major dovish reaction could be tricky. Even though the current risk-off environment does favor the yen as well as the Swiss franc, if we see a massive 100 basis point rate cut as well as an introduction of QE, that would be seen as a positive move for equity markets and could see a risk-on tone develop, which would be negative for the yen as well as the Swiss. Thus, if we do see a major dovish reaction in the dollar to the Fed causing big equity inflows, we could look to rather pair the US dollar in the short term against high beta currencies like the Aussie and the Kiwi that are expected to see some upside if we do have a strong risk on move resulting from equities. However, if the risk on tone or if the risk tone is mixed at the time despite an overly dovish Fed, we could look to trade the euro against the dollar, as it would be more neutral to risk flows and remain the most liquid currency pair on the market. Alternatively, if we see hawkish developments for the dollar, we can look to pair the dollar against something like the Canadian dollar, which has been pressured by the BOC also cutting rates by 50 basis points and signaling that the bank will not hesitate to cut further if the situation requires it. Another challenge for the CAD is oil prices. That's been hitting very low levels as global oil demand tanks on OPEC Plus failing to achieve an agreement for additional production cuts, and also the price war that has been instigated between Saudi and Russia that is keeping oil prices very low and pressured in the short term. Now, remember that these recommendations are based on the current fundamental bias for these currencies at the time of writing and can change throughout the week. Make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Now, then looking at any possible economic news to trade into in line with the US dollar. Now, as the biggest focus for the dollar this week will be on the outcome of the FOMC, we would not advise on trading into any upcoming economic data points such as retail sales for this week, etc. Rather, keep your powder dry and look to the FOMC to provide the highest short-term catalyst to the up or to the downside for the US dollar in this week.